World oil prices seem like they're on an endless roller coaster, shooting up, plunging down, shooting up again. For example, in a few short weeks in early 2022, the world oil price shot up 65%, hitting $130 US per barrel. Then it plunged right back down to $80 a barrel by year's end. So what's behind this roller coaster pattern, and who does it really benefit? I'm Jim Stanford. I'm the economist and director of the Center for Future Work, the sponsor of False Profits. Let's dive into how world oil prices are actually determined, and what we find may surprise you. Now, when people hear market, they typically think about the laws of supply and demand. If demand is high, the price goes up. If supply is high, the price goes down. In theory, an efficient market sets a price that equalizes supply and demand and reflects the real cost of producing that commodity. But in the real world, most markets operate very differently than the textbooks. And the world oil market is one of the strangest. Oil is one of the most important commodities in the world. For now, anyway, its price can cause major economic repercussions. The world price of oil is not set in a gigantic market where people buy and sell actual oil. Instead, the oil price is set in a financial market where people buy and sell financial contracts. It's called the oil futures market. It operates on computer networks around the globe, not at oil fields or shipping terminals. And most of the people who participate in this market have no real interest in either producing oil or using it. They're interested only in buying and selling paper contracts and making money in the process. It's called speculation. Buy low, sell high. Or, with the right derivative strategy, buy high and sell low. Either way, as long as the price is moving, speculators can find a way to make money. The only thing speculators can't stand is stability. After all, a roller coaster is no fun if it's not going anywhere. Speculators feel the same way about futures markets. Now, a futures contract is a piece of paper that obligates its holder to buy a set amount of a specific type of oil at a specific place and time. The problem is, there are far more futures contracts sold in any given month than there is oil produced around the world in that same month. Consider just the two biggest oil futures markets, West Texas Intermediate in North America and Brent crude in Europe. They trade paper contracts worth 500 billion barrels of oil per year. That's 13 times more than the actual amount of physical oil produced anywhere in the world. And the vast majority of these futures contracts are then canceled through counteracting trades before the date for accepting the oil arrives. Only about 1% of the participants in futures markets have any intention of ever taking a single barrel of oil. Oil futures trading is worth $25 trillion US per year. With all that money, not oil, money, sloshing around, the futures price can fluctuate dramatically with any change in expectations, hopes, or fears from speculators who trade those contracts. The resulting price changes are far larger than would be justified by actual changes in supply, demand, or production costs. All the things that are supposed to drive the efficient markets we learned about in the textbooks. Well, that's exactly what happened in February 2022. The invasion of Ukraine sparked fears of a wider global conflict. Ukraine doesn't produce oil, but Russia does. And regardless of any actual shocks to real oil supply, traders recognized this war was a good trading opportunity. Thinking the price might rise, traders jumped in. The resulting rise in demand for paper, not for oil, drove the oil price higher. That sparked more buyers and still higher prices. As it turned out, the invasion of Ukraine had no impact on world oil supply at all. Oil supply continued growing throughout 2022 and afterward. As this became clear, the futures price came crashing back down. It is not natural or inevitable that prices for one of the most central commodities in our economy should be set this way. But the oil industry loves it, because when the roller coaster is going up, they make untold profits. close to $200 billion for Canadian oil and gas companies from 2021 through 2024 alone. Remember this the next time oil and gas prices spike. It's not supply and demand at work, it's a system that puts the profits of financial speculators and petroleum corporations ahead of our needs for affordable energy and economic stability.